Cool, guys. I think let's get going. We might still have a few guys join us, but it's just after 9 o'clock, so let's kick off.
Yeah.
If I can please ask that you just mute your mics on your side. As always, you're welcome to ask questions as we go. You can either unmute and ask it or just put it in the chat column and we'll pick it up from there. Lisa, if you wouldn't mind just jumping onto the agenda slide. So 3 things we want to talk about this morning. Welcome and thank you all for joining us. So we do appreciate your time and your attendance. So yesterday was an interesting day on the markets. Most of you probably have seen. We had a green day for the first time in many weeks. In fact, you had to look quite hard to find any red spots on the screen. I think in the US, all 11 the indexes was positive yesterday. I think I had a quick look through all the indexes, and I think it was only Russia, Portugal, Nigeria, Israel, and the Philippines.
How's it? I'm good, thank you.
If you wouldn't mind just muting on your side. As only those 6 indexes that was marginally negative yesterday. Otherwise, we saw green across the board. The mighty dollar had a little bit of a pullback from its recent bull run. And looking at the futures this morning, it looks like we're potentially in for another positive green day. Just to recap a little bit, before Ian's going to talk to us mainly around asset class expectations, work that BCA has done and that we've done, looking sort of 10, 15 years into the future, applying as much science as can be applied to forecasting these numbers. So Ian's going to take us through that. And then Tawanda is going to talk particularly around the income fund space. A little bit of a wobbly in June. The July numbers looking a little bit scary as well. So T-Man's going to give us a bit of context around that. And then I'm going to just chat to you guys around the importance of client investment strategy. Those of you with Seed Analytics would have gotten an email yesterday that your client statements are ready, and those statements are going out. And I think clients might ask a few questions. They certainly have been. We've been getting quite a number of questions from clients and from you guys with all the turmoil in the market. So just a little bit of a positioning around that. But just before I hand over to Ian, so we're sort of halfway through the year. The first 6 half was a tale of blood and gore. Glas, bloed en bottelstukke, as we say in Afrikaans. But if you look through all the noise, it was really a story of inflation continuing to ratchet up. You will remember we were talking about transitory inflation, and now inflation certainly seems to have been a little bit more sticky. And on the back of that very high inflation, we saw interest rate hikes around the globe, and we saw share markets repricing, revaluating based on these higher interest rates. There is a sense that maybe inflation has peaked or are peaking. And of course, once we understand what's happening with inflation, we can then get a much more certain view around the interest rate hike cycles. And as you know, markets like certainty. So we think that process is kind of coming to an end. And then if we look for the second half of this year, what we think is going to drive equity markets around the world is really company earnings. And what effect the last 2-3 years has had on businesses, this high inflation, how much of that has caused profit margin compression, where companies and businesses couldn't really pass that higher inflation down to consumers. So we'll be watching companies' earnings quite closely as they come out and guide equity markets around the globe. So on that note, Ian, I'm going to hand over to you to give us a sense of what we can look forward to from the various asset classes over the next few years.
Thanks, Adrian. And morning, guys. Great to be with you again. So we trust that we can get a little bit of some insight here. As Adrian mentioned, but I'll this is the first thing you mentioned, inflation. I thought I'd put this little meme up. It's one thing to actually predict inflation, as this little kid did. Wow, kiddo, how much dollars did you make? No, he actually put it into inflation hedges, gold and Bitcoin. And obviously we know what's happened this year with those 2 assets. And Bitcoin especially. Gold, it's not too bad. It's down about 6% or so for the year to date. Okay, so jumping into expectations. And this is just a couple of thoughts here. Firstly, this is, as Adrian mentioned, it's from a specific BCA report that has tried to look at long-term numbers. And I need to stress the long-term numbers because there's actually a lot more predictability with respect to long-term numbers as opposed to short-term. Short-term, we don't know what's going to happen next week. We don't necessarily even know what's going to happen in the next 12 months. But over the long term, there's a much higher degree of predictability. At the same time, they do make the sort of note that there is some art into this. It's not a pure mathematical science. So there's a lot of science that goes into it, but you can't. It's not 100%. That's just the nature of markets. Markets are complex, adaptive systems. But it's based on a couple of assumptions. The main one being the interest rate, and that's your base rate is your long-term government bond. And then the second assumption is that there's a degree of relationships between assets. And over long periods of time, this does tend to hold. So as you go up the risk scale or down the risk scale, you actually are rewarded or not rewarded, and there's relationships between asset classes. And that's the sort of premise and underlying assumptions that they use. So a big fact has been that the risk-free rate has increased. This is the fact. This is the issue that has caused a lot of anxiety and stress and prices coming off dramatically. What is the risk-free rate? What is your 10-year bond yield in the US? That is typically seen as the risk-free. I put risk-free there in inverted commas because it's not purely risk-free. Certain investors have felt that risk. The most obvious one has been Russia, where their reserves were unilaterally taken away. So it's not purely risk-free, but for all intents and purposes, when you put your money into the US 10-year, when you lend money to the US, you're going to get your money back for the most part. And we've seen that rate increase quite substantially now over the last 12 months, and especially this year. So that's your base rate, and we'll come back to that. And then just in summary, but we'll look at this again, a year back, a balanced global portfolio. And I'll just need to stress as well, all of these returns are in dollar terms, and then there is an assumption for how much the rand will depreciate over a period of time. And we can look at that as well. The assumption, a year back, the long-term forecast was only a 3% return in dollar terms. And now, given the fact that prices are down, interest rates are up, that has increased to 5%. So when they did the same analysis 12 months back, it was 3%. Now it's jumped to 5%. And we'll look at that in the context of where that should be. Yeah, I think the big issue is relative to current inflation. And we saw inflation come out last week, 9.1% in the US. It's a huge number. So clearly, relative to the current inflation, it's on the low side. If we're thinking dollars to dollars. But again, there is an assumption that inflation will average now over 3%. And you might say, well, that might be optimistic, but that's what they are looking at over the, let's say, if we look back if we stand back 10 years from here and look back, the assumption is that inflation will average up to 3%, which is higher than the longer run number. Okay, so let's get into it. And what I've done is I've summarized. There's a detailed report with a lot of the detail as to how they've achieved all of these numbers. But the returns are what has happened in the last 20 years for each of these asset classes. So this is cash and bonds. What's been the volatility of that asset class? And now looking forward for 10 to 15 years. So this is not for the next 12 months, not for the next 6 months, not for the next 2 years, but a long run number. So cash, 1.2%, UK cash, 1.8%, government bonds, US government bonds over the last 20 years have given you 3.3%. And that's the volatility. So 3.3% in dollars, nice and simple. That's what you've got with relatively low volatility. So it hasn't been negligible, but it's been a degree of volatility. Where we stand now, because those interest rates have come up, they're hovering around about the 3%. They did this report in the last week of June. but we'll see. So 3.3% is what they anticipate, and it's pretty much mostly where your starting yield is. UK government bonds, they see a decline there from previously, and that's largely to do with currency. We'll talk about that. And then emerging market US debt. So they've lumped all emerging markets together. So included in there would be South Africa, but obviously there's all other emerging markets, Brazil, Mexico, and obviously China and the whole bunch. And obviously for the extra risk over the 20 years, as an investor, you would have been paid 6.6% in dollar terms. With, as you can see there, a higher degree of volatility, 9.1%. The assumption now going forward, given where rates are, is that is at roughly about 5.6%. So that's your sort of base case scenario in terms of, okay, and I think it's important for investors, and well, especially advisors, to understand, okay, you know, how returns are going to be made up, because we see numbers up, down, all over the place. You know, where we, you know, how do we make sense of it? And I think this is the way I look at it, this is a bit of a grounding. It's almost like your North Star. What is the North Star, you know, in terms of returns? There's a higher degree of predictability with respect to these numbers, just by the very nature and the low volatility that you typically are going to receive. Okay, well, and again, I just want to stress this is all in US dollars, and we'll look at the currency effect after that. Second one we've got to is obviously your main asset class, where we want to see a pickup, and that's your equities. I've just, again, summarized a few markets here. So global equities, 7.7%, 9.2%. The US over 20 years has been very good. It's come in, and it hasn't been a straight line. We know that, that's for sure. With a high, with volatility much higher, obviously, than fixed income. So 15, 16%, all the way up to emerging markets, and that obviously includes SA and the works, and clearly China is the big one, 9.5%. So you've got the extra reward. It's come with extra volatility. On the right-hand side this is what they are looking at, and they haven't just sucked a number out of their thumbs. For each one of these areas, geographic regions, this is an average of 6 equity valuation methodologies, and it's fairly detailed. So there's a degree of science to it, but obviously you make some assumptions as to what is the risk premium going to be, because obviously when it comes to, let's say, emerging markets, or let's say even Canada, there's a degree of an additional risk premium that you want to be applying relative to, say, the US. Now, clearly what you can see there is that in certain markets, it's looking much lower. 9.2 in the US is a decent historical number in dollar terms for your equities. That's come all the way down to 5.2. Now, that's clearly a function of the fact that prices, even though they've come off substantially, are still a little bit more elevated than where they have been over the last 20 years. But it's not the case for all markets. The differential is a little bit more muted, clearly in Europe and UK, Canada, a little bit less so, and then the degree in emerging markets as well. So that gives you a little bit of a sense, and we'll come back to that if we combine a portfolio together. The third component, so we've got fixed income, we've got equities, and then the third component, which is an interesting component, and again, this is a subset. I think there's about 7 or so categories, but this is your alternative investments, which is property. They also included hedge funds. We haven't typically looked at that. Property, commodities, gold, anything else which is your sort of alternatives. And obviously here, what we see is it's been generally a good space over the last 20 years for a lot of alternative investments. I mean, the classic one is private equity. 14.7%, you know, if you had access to private equity, which is not always easily available. These asset classes have come with a much higher degree of volatility, as you can see there, relative clearly to fixed income and even your listed market. But, you know, you've been rewarded for the most part. An interesting one there is commodities. So commodities are, and we've seen this year especially, but it's nothing exceptional. They come with a huge amount of volatility, but long term, it's produced 1.1%. And there's a lot of very good reasons for that. Going forward, they again not predicting, and you've got to make some assumptions as to how you get to that. But a lot of it has to do with GDP growth. So a lot of this, the assumption with respect to the commodities and even the gold, is a sort of ratio and linkages back to GDP growth. For the property one is very interesting for us because property, they're looking 8, 9, even up to 10% for direct property. Now that's obviously there's a degree to which you're linking your future returns based on your current capitalization rates, yields that you're getting. So it's more of a yield return plus a degree of capital appreciation. I think the big one is private equity. There's a degree to which maybe it's similar to listed equity. It's moved up. It's been a fantastic asset class. So, it's a lot more muted, 9.3. You're probably still going to see the same amount of volatility in these asset classes, but the degree of just tapering down of the expectations going forward. Again, these are all US dollar terms. And then gold's been fantastic over 20 years. It hasn't been a straight line, been huge ups, huge downs. Down this year, it hasn't been a fantastic asset class, as we saw there in that meme with respect to the inflation environment. Everyone sort of expected, okay, well, gold should do well. It sort of dances to its own tune, so to speak. They're thinking and looking at it being much more muted at 4.5%. If we put that together, so if we just combine that in a 50-30-20 portfolio, 50% equities, 30% fixed income, and 20% alternatives, so it's a type of global balanced portfolio, you would have received 6.6% dollar terms at 4 to 5%, rand depreciation historically with that type of volatility. Going forward, that given the makeup of the individual components, that's looking at about 5% now. Probably a similar amount of volatility, but no one's anticipating volatility or trying to anticipate what the volatility number is. We're just really trying to anticipate and calculate as best they can the return number. So for sure, it's definitely much lower than where it was over the last 20 years. But as I say, and we've got a chart there, it's jumped up from the last, if we calculated this last year. Then if we look at the currency, again, I've just put two of the components here. They've got all the emerging markets, and there's only. It's interesting because each of the currencies on a PPP, purchasing power parity basis, and that's a way of looking at the interest rate differentials and inflation differentials. Every single one of them is undervalued. In SA's case, they calculate 56%. And remember, if we've looked at this and demonstrated and showed this as well, and everyone looks at this, everyone comes up with the same answer, that the dollar is super strong. So there's no doubt about that. And all currencies, and especially the emerging market currencies, are undervalued on a purchasing power parity basis. Be that as it may, they believe that there's actually only two emerging markets, that's Brazil and SA, that will depreciate. In total, there's only a couple of the emerging markets that will appreciate. In totality, a basket, asset-weighted basket of emerging markets that will depreciate at call it 1% per annum. I put SA in there. Their analysis is that we should depreciate at 3.7. So call it 4%. It is interesting because some other analysis that came from Prescient also talks about the 4%. So call it a 4% per annum depreciation of our currency relative to the USD. So even though they're acknowledging that we're undervalued relative to the super strong dollar, the analysis indicates that we're one of the countries that will depreciate from a currency perspective at 4%. China they put at 0. I'll just put those two currencies up there. So some closing notes. So it's largely to do with valuations. How we're projecting the future returns based on valuations, but valuations are not a good short-term timing tool, but they're actually a very powerful indicator of long-term returns. And they've got some stats on that. We've seen that as well. your starting value has a high predictability of your future return, but it doesn't necessarily indicate what's going to happen over a short period. And that's especially for fixed income, and especially for equities. The interesting thing, which is quite fascinating, is that the alternative assets has been good, and the projection is that another pretty reasonable return, as we've indicated there, from a basket of alternative assets. As I say, we only showed a couple of them there, but that's largely your property, a little bit of gold, not necessarily commodities. And then the other factor, which they do mention, and I thought I'd just put some of these points up here. The concern clearly is, what is inflation going to do? Structurally, I think we all recognize that there should be higher inflation. And some of the factors that they've included there is an increase in protectionism, the deglobalization that we are seeing, and it's not only now, it's not only from the start of the Ukraine war with Russia. It's been a couple of years already. Increase in wage pressures. Definitely this transition away from fossil fuels. So we know that there's been underinvestment in that. There's no finance for that. So this is all inflationary. And then an increase in the so-called dependency ratio, which is the non-working to working. So this is happening around the world, and it is inflationary as well. So these are some of the factors. So I think we all acknowledge that inflation should be on the higher side. As I say, their anticipation is that it should come up to around about, let's say, around 3% in dollar terms. So I've just got one chart here. So just to put this into chart format, and I'm comparing. So the first bar is the historical number. So this is the historical number. The second is if we did that same calculation, and they did the same calculation last year. So global equities, as you can see, there's jumped up from an anticipated 3.1% to anticipated 5.5%. And your balanced portfolio has gone up from a 3% to a 5%. And that's because interest rates have moved up, prices have come down. So things do change. So really the question now is, is it enough? Again, this is all in dollar terms. We have to add on currency depreciation. If we agree and concur with the assumption that the rand will depreciate at a similar rate. I think, if we look at this and everything, and we look at, maybe is a little erring on the side of a little bit of caution, but if you look at the makeup of how they've looked at each of these components, as I say, for equities, there's 6 valuation methodologies, and then the averaging of those. Our job and investors' jobs are to obviously get the right asset allocation, firstly, and then secondly, obviously, these are averages. You want to cut out the assets and the funds and the specific shares that are going to pull your average down, and try and get into the shares that are going to get your averages up as best as you can. But I'd like to think that this gives a little bit of as I say, a bit of a North Star, so to speak. And I think it is quite important to get the expectations right as best as possible. So just to reiterate, this is all in dollar terms. We're trying to, we have to think and try and think a lot more globally in terms of how we think from a return perspective. And then we can always just add the currency depreciation as an overlay. So thanks, guys. Any questions? Happy to take them, and let's see if we can answer. But back over to you, AD.
Thank you, Ian. Maybe just from my side, if I look at these numbers that you got up here, Ian, and then I think of investment strategy, and I'm going to touch on that later on in the preso. But we're sort of saying, for your clients with a long-term horizon, 10-year plus, that's going into that pure equity space, be it local or offshore. Typically, they would target inflation plus 5-6% over the long run. Now, if I look at where inflation's at, and I'm looking at these numbers, we're not going to get there on average. But as you rightly say, I guess what then becomes really important is stock selection, as opposed to maybe just a whole index fund where you're buying the good with the bad, but looking at managers that's got that track record of generating alpha, because at these kind of numbers, you're not going to get to your long-term strategic numbers. But if you invest in a fund where there's maybe that additional 1 or 2% of alpha, then I think you'll get a lot closer.
No, that's quite right. I think as we've seen, over long periods of time, in any case, and achieving the return above inflation is not an easy task. Perhaps in some ways, there's been a degree where we've had sort of maybe tailwinds globally for the last 20 years to some extent, with inflation coming down and down and down. A huge factor globally has been the China impact, where it effectively opened up a huge amount of productive capacity, and prices and globalization helped. We obviously are seeing a bit of a reversal of that. I think in general, and it's the point that these guys make as well, and it's something which we are engaging with all different managers, and I think there's a sense of this, is that maybe some of the expectations have to come down in terms of the inflation plus returns that you make globally. That is the case, and especially and obviously even here. And then yes, then it's a matter of getting the right asset allocation. As we can see there, and this is something we've got to think about, is maybe there's a little bit, there's something there in the alternative space, more of the alternative space possibly, and then eking out, trying to just, you don't want to be in assets which are going to pull down your return, and then cost factor. So it's a number of things to try and eke out returns above that inflation number, and it's not going to be an easy task. I don't have any doubt about that, because inflation, if it does tend to be and persist on the higher side structurally, it's a tall and a tough hurdle to meet. So yeah, I don't have any doubts that we've got our job cut out for us, for all of us, investors and advisors. And we just have to try and figure the lie of the land.
So can I just ask a question quickly? It's okay. I actually mentioned to Adrian the other day
Harry, I think you've just muted yourself.
Is a GRP the better way to go? I mean, a GRP now at the moment looking at 7.5% return, that would fall more. I mean, would it be best, with so much uncertainty and volatility, to be advising clients to go into a GRP space that will guarantee like a 7.5% return? No questions asked, no worrying about management and the likes. Is that not a good space to be going into going forward for the next while, looking at these numbers?
Thank you, Harry. Good question. Jens, I don't know if you got that, but Harry's asking about the relevance of maybe a guaranteed investment bond, where you're getting sort of north of 7% currently net of fees and taxes, as a potential investment for clients.
I mean, we've looked at this, and I think Tawanda will touch on this a little bit in terms of just the additional yield that we are getting on the local fixed income space, i.e. from the government bonds. And it's that higher yield which is allowing the life companies to effectively pass that through to the investors from a sort of guaranteed space. So whether you're going to get that in terms of buying a guarantee, or a combination of a guarantee and then investing into fixed income space, because yeah, I think there's definitely a possibility and definitely more optionality, and we have seen that. As I said, Tawanda will touch on it a little bit, because we've seen interest rates on the long end move up pretty sharply here locally, and it's giving that optionality, so to speak, to investors. It might not necessarily be available globally, but definitely if we look at it, we wouldn't necessarily dismiss it outright. Whether you would want to put all, whether you want to back the truck into that, I don't believe that is the case, because you've got flexibility within funds to move as the markets move. But as we speak now, there's probably there's probably higher merit in it at the moment, given the higher interest rates, and then obviously the rates that they are able to be offering out. So yeah, I think there's definitely merit in it.
I guess a big risk with that, Ian, is potentially what inflation is going to do over the next 5 years.
Yeah.
So you lock in maybe a 7.1 or 7.2, but if your inflation numbers are sticky around similar levels, then on a real term basis, is a client really moving forward? So that might be one caveat around
that's
that.
exactly it. I mean, the inflation is and you're locked in. So yeah, you're taking a view. So that's why you've got a higher degree of flexibility with funds. Hopefully they can navigate the space. Tawanda will just touch briefly just on some of the fixed income space, which in the shorter term, what you don't have is that sort of marking of the fixed incomes as the yield moves up, and that's what we're experiencing now. So investors get nervous because they get the numbers come down because it's the mark. You don't have it in that. So I think there's a space for it, but I'd be cautious of putting everything into it, because as you say, next minute you're locked in, there's no flexibility, and inflation does move up and be stickier, and now you can't do much about it. So it's horses for courses, and I think it gives that extra degree of optionality, which is important.
Thanks, Ian, and thanks for the question, Harry. It actually leads nicely into T-Man session. And just before I hand over to you, T-Man, I think, Lisa, you can move on to T-Man's side. You guys, as you're sending out statements now to your clients, you'll see for those who are on income funds, I think it's 84% of the income funds had a negative return number for June, although it was marginally negative. And in July, so far, also is tracing probably negative if nothing changes. But there's good reason for that. And we felt it might just be worthwhile for us to unpack that with you guys, so that you've got positioning that you could put forward to your clients. Because our income fund is still currently yielding 8.8%, and that would be sort of the best indicator of what you can expect on a gross basis over the next 12 months. But you've got that short-term disconnect where we're talking 8.8% on a 12-month yield, but last month was negative. So T-Man, will you please give us some clarity around that?
Okay, that's a huge task here, Adrian. Thanks for that, and good morning, guys. Great to speak to you all this morning. Okay, so in the context of all the volatility that we're seeing in the markets, we've seen a lot of assets selling off. I thought in that kind of volatility, income funds become more and more important as investors look for places to park their money and look for places that are a lot less riskier and safer just to be invested in. So income funds in that context are really, really important. And one thing that we've been saying, and I'm sure you've heard this from a lot of other managers who invest in fixed income as well, we've been talking about the really, really attractive opportunity in the South African government bonds. I think those yields are very attractive, and the kind of real yields that you're getting above inflation is very, very attractive. So there's a big opportunity that we've been finding in the South African government bonds. And also, I think what you've seen in those income funds with the interest hikes that we've been experiencing in the recent past, that those yields continue to go to increase over time. So if we just move on to the next slide, Lisa, this is a chart that we put up in our May session when we spoke about the attractive opportunity in bonds again. And this is just the comparison of the yield between bonds and cash. And if you compare to the history, what the bonds are trading as the current yield relative to cash is at a very, very attractive rate. So I think this goes on to explain that why we why we and other managers are favoring that opportunity in bonds, because the yield that you're getting in the bonds is far much more attractive, and is obviously more attractive than what you're getting in cash. But then if we speak about this yield, if we then look at how the income funds have performed, and this is what Adrian has briefly touched on. If we look at what happened during the month of June, most of the income funds in that multi-asset income category actually delivered a negative return. So that number is 84% of the funds actually delivered a negative return during that month, which just goes on to show the difficulty in the current market. Bonds as an asset class really sold off during the last month, and then also some credit assets, like especially in Europe, if you've got like exposure to funds like the BCI Income Plus, or the Fairtrade Income Plus, which is exposure to European credit. As that credit as the credit spreads widened, you actually experienced losses within those funds. So various reasons that explain this, but primarily those bonds are setting off. You can see that in June, most of the funds, most of the category actually delivered a negative return there. And month to date in July so far, with bonds continuing to sell off, you can see this with the way the rand has moved as well. The rand is also sold off. That you can actually see that those assets have been experiencing negative returns. If we move on to the next slide, our fund also delivered a negative return there, but if you just go, the fund was down 0.4%. If you just compare that to the average fund within that category, was actually down negative 0.6%. So that was, in as much as it was a negative, that was actually the second quarter return, which actually shows you how difficult a month it was in June. Cash gave you 0.4% there. But if you look at the bonds, that's just the all bond index return there, minus 3.1%. So you can see the biggest contributor to that negative return is coming from those bonds selling off. And if we just look at what those various assets have given you over the last year, then obviously our income fund has given you 4.7%, the average income fund at 4.6%, cash has given you slightly lower at 4.2%. So this is despite those negatives that you've experienced in the income category. Cash has still given you much lower over the last year. And as you can see, the bonds have struggled over the last year just by virtue of the sell-off that we've experienced so far. And if we just move on to the next slide, this the bond selling off is really a case of the negative sentiment that is going on globally. I think we've spoken about all of these macroeconomic issues. So you've got global issues and South African issues that have contributed to assets selling off. This is both equities and fixed income assets, bonds in this case. On the South African specific side, I think it's been a bit of a struggle. I think we've all experienced this pretty bad load shedding, and globally, as guys look down at South Africa, then obviously that hasn't been great. So you've seen the South African assets selling off because of these reasons. So you look at the load shedding, you look at the inflation risk, you look at the rising interest rates, you look at the recession fears that everyone has, and obviously the geopolitical instability that we've got globally. Then there's a lot of negative sentiment that we've obviously been experiencing that has obviously led to assets selling off. But if we look at the real yields now that we've been getting, so as these bonds sell off, then obviously we are able to pick up the bonds at very, very attractive yields. So the pricing of the South African bonds, just on a relative basis, relative to global peers and just relative to its own history, you are actually picking up the bonds at a yield that's more attractive relative to the peers and relative to its own history, and obviously that is giving you real yields above inflation that are very, very attractive. So if we look at the build up of what makes that yield so much higher, if we do just a build up, obviously the contributing factors would look at the if we look at a model, then you'd look at the contribution of the US yield as an example, which has been increasing. If you look at the inflation differential, South Africa actually has lower inflation than the US at the moment. So as a build up, that would contribute negatively. But the biggest thing that is contributing is the SA risk premium that has obviously been ticking up. So globally, then everyone would just be looking at that SA risk and saying that the SA risk is much larger. I think with obviously the load shedding and things like that, then you could consider that to be a higher risk premium. But also, if you look, this is now comparing to our history. The SA fiscus is actually in a much better state than it was in recent years. This is obviously looking at the amount of taxes that we've been able to collect with the commodity boom that we've been experiencing, that the actual fiscus is actually in better shape. So that risk premium, whether it's larger than its history, and yet the fiscus is actually in a slightly improved state. So that goes on to say that if we just move on to the next slide, Lisa. This is just to look at the bonds that the bonds are not necessarily a risk-free investment, because they do go through these drawdown periods, like exactly what we're experiencing right now. But those drawdowns, they don't last for a long time. So this is just to make you aware that going through a period like this is very much normal, but it is not a period that lasts for a very long time. It is actually just a period that offers a big opportunity for you to get exposure to these bonds at a much more attractive rate. Because what happens post a period like this is that there is a recovery, and this speaks to the bond investment case that we will speak about in our next slide, Lisa. That bond investment case actually remains strong. So in as much as you go through a period of drawdowns, through a period of negative returns, as we've seen, if we look at the history of the old bond index, as an example, just to put this point across, just so far this century, if you look at now the rolling 12-month returns, the old bond index, in spite of these drawdowns that it goes through, they can be even more than 5% at times. The rolling 12-month returns are positive, have been positive roughly 95% of the time. And the old bond index has actually experienced a 5% drawdown at least once a year. So over this, so far this century, just once a year, it goes through a 5% or more drawdown at least once a year. But after going through that 5% drawdown, which is why I'm highlighting that such drawdowns, they give us an opportunity to access these bonds at very, very attractive yields. Post a drawdown like that, the 12-month returns have been positive 100% of the time. And then the average 12-month return actually shifts from an average of roughly 10% to above 13%. And the reason for that is that that yield that you get exposure at is a much higher yield. So you've got a fixed coupon that's very attractive, and obviously the maturity of those bonds. If we just look at the investment case, then the chances of actually going through a default remains very, very low, because this is rand denominated exposure. So the chance of actually experiencing a default would be very, very low. Obviously, like we say, when you look at any assets, there's always risk to an investment case. So if there's further deterioration, both locally and globally, then obviously that's the risk to the investment case. But like I said, the chances of default are very low, and obviously we are getting exposure at very, very attractive rates, and that bodes well for the kind of returns that you will get over the next 12 months or going forward. And as Adrian alluded to earlier on, the kind of good indication that you get to what you can expect to be getting from the income funds is that kind of yield that you get in that portfolio. So if we just look at the last slide that I've got here, just the seed income portfolio, how we've constructed the portfolio and the current gross yield of the fund. Because of this kind of exposure that we're getting to all these different assets at a very attractive yield, then the gross fund yield is actually gone up to 8.8% right now. And obviously how we've constructed that portfolio, diversified sources of yield. So you've got the bonds, but in addition to the bonds, then you've also got some credit exposure and some niche strategies that we've got there, like a prescient clean energy and Ashburton high yield. So, and we've also got some low risk exposure just to something like a standard income. So the portfolio offers you diversified yield sources. We've got a very attractive gross yield at the moment, sitting at 8.8%. If we get additional interest rate hikes, then obviously that yield continues to tick up. So the big message here is not to panic. I think I'm very excited about the kind of opportunities that we're getting in the bonds, in as much as it's very disappointing to see a negative return in a month. This month has also not been great so far. I'm excited about the kind of opportunities that we've gotten in the market, and this kind of gives you the kind of returns that we should be anticipating going forward, just based on what the kind of assets that we've been getting exposure to. Thanks. That's it from my side, Adrian.
Thank you, T-Man. Guys, any questions for Tawanda? Because otherwise you can start rolling into my piece and the next one. So we thought about maybe just sharing a few ideas with you guys and a couple of slides that we think can be useful, particularly as you sit with clients doing reviews or getting queries from clients in this environment around recent performance or first half of the asset class performance. And it comes back to, Ian spoke about it and Tawana spoke about it as well, is that investment strategy that you built for the client, is getting the clients in the right asset classes according to their short-term, medium-term and long-term investment goals. There's obviously the risk appetite overlay from a client perspective, but in my experience, that's less important. That's almost a journey that you got to take the client on, if the client's very conservative, to get them to the point where they understand that for their longer term asset growth, they need to take on risk in order to achieve the higher numbers that they need for retirement, for example. And if you do this correctly, if you do your investment strategy for your client correctly, then that phone call coming from a client or that email from a client in these kind of times is a lot easier to answer. And this is just sort of a snapshot. At the top of the monthly shortlist, there's also a little caption of that investment strategy that looks like that. It talks to exactly the same thing. But just to give back to the previous one, Lisa. So for your 3 years liquidity needs, be it an emergency fund, be it the client's income that they're drawing out of a living annuity, that's on the far left. We need to invest that conservatively. So that's a mixture of cash and fixed interest. Typically, your income fund space that Tawanda's just spoken about. It's not completely risk-free, as we've just seen in June, but over a rolling period, 3 to 6 months, you would certainly expect a positive return from that, and we're targeting inflation plus 1% in that space, in the income fund space. So at least your client still keeps up with inflation, even in the emergency pot or in the income pot. Gross yield at the moment, as T-Man said, 8.8% on our income fund. And then you sort of go into that 3 to 5 year money space, which is not a lot of flows in that space, but for certain clients that does come into play. There you start introducing a little bit of risky assets, low equity managed funds typically, and there you start targeting sort of inflation plus 2 to 4%. And then as your client's time horizon goes to 7, 10 years and longer, you go into the balance fund space, and then ultimately your pure equity, local and offshore where you would be targeting inflation +5, inflation +6 over the long run. Thanks, Lisa. You can jump to the next one. And where that is so important is when your clients when you sit with your clients and you do the discovery, you do the F&A, and now you do that investment strategy, you've got your conservative clients who said, listen, I want to sleep well at night. I don't want to see any red on a monthly basis. And Harry, to your point, GIB is maybe the default solution there. You can sleep well and the client can sleep well. But at 7% or 7.2%, you're only keeping up with inflation. Is it right to put a client's 10, 20-year retirement money into a GIB? One could argue probably not. You need to target more inflation +5% for that long-term retirement money. So the client might be risk averse, but that's where our role as financial advisors come in to educate the client. On the other hand, it's that question then, yes, you might sleep very well until you're 60 or 65, but then you're not going to have enough when you retire. You're not going to be able to eat well. And that's where you start going from the lifestyle that you used to a much diminished lifestyle. And obviously that's not ideal. And if we look at the next graph, this equation just holds true over time. And it's as true today as it was 10 or 20 years ago, that unfortunately to get the higher returns, you have to start introducing risky asset classes into the client portfolio. In the short term, we've seen these numbers distort, but over your 5, 10, 15-year periods, this relationship typically holds that the higher the risk, the higher the return over the long run. And then just when you have this discussion with a client, it's so important to do this positioning upfront, to say to the client, look, we are bringing risky assets into your portfolio. We're bringing property in, we're bringing equity in, we're bringing some alternative asset classes in to get you to a CPI +5 target over the long run. But understand that over a rolling 12-month period, your property portfolio could be down 34%. Your equity portfolio could be down 23%. But on average, it will be up more than it's down. And over the long run, it's going to give you that additional growth that we need to get you to your long-term investment goals. And then also understand that asset classes over and underperform relative to each other over time as well. We've all had some pain over the last 2-3 years out of the property market. And that's that black line that you can see there at the bottom. But you can see at times, with the exception of cash, which is obviously fairly steady, you have equities, property, bonds that outperform and underperform relative to each other. And that just makes the case to maybe put your client, except of you going into direct equity fund or a direct bond fund, to go into a multi-asset fund where the portfolio manager can make that decision over time as they do the evaluations on the asset classes relative to each other, and make the over and underweight tactical allocations over time. And of course, if you do get those clients who say, listen, I hear everything that you say, but I don't want to see a red number on my statement. I want a conservative investment. Put my money in the bank, or give me something that's not going to ever be negative over a rolling 6-month period, for example. That's good and well, but I think it's important to also understand the impact of that decision. And what we've done here is just show you over a 22-year period what the different asset classes would have given you from the CISA sort of classification perspective. So cash over 22 years cumulatively would have given you a 333% growth. What we didn't overlay here is inflation, but most probably that cash number will be lower than a cumulative inflation number. The low equity portfolio, so that's your 3 to 5 year numbers, that would have given you about 571, medium equity 700, high equity 775, and then pure SA equity 1,205%. So you can clearly see that risk-return relationship holding in this graph. But what you can also see is the volatility of the road to get there. So your cash is a straight line, and then you can see the volatility increase drastically. And if we look at that top line, the blue equity line, yes, we had the 708 financial crisis. We had the 2018 market correction. We had the March 2020 COVID correction. And currently we're in a correction phase as well, with the markets re-rating on the back of inflation and interest rate hikes. But one could argue that maybe, as we look at this graph, we are at or entering perhaps a buying opportunity, an entry opportunity into the equity markets for clients that have funds to invest. So maybe a good slide to have in your arsenal when you sit with your clients. And this is also still true. The only surefire way to lose your clients' money in the long run on a real term basis is to have their funds invested in cash, to put them in a money market or keep their money in the bank. Because if you adjust for tax, and we assumed a 40% tax rate here, but even at a 30% tax rate or 25% tax rate, the bottom line numbers are still negative. And you then adjust for inflation, your real return year on year in cash is negative. And remember that rule of 7. So essentially every sort of 7 years, what you can buy with your money halves. So what's worth 100,000 today and 7 years from now will only be worth 50,000 in today's terms. And to combat that, you have to expose your client to risky assets in their portfolio for the long run. And then maybe just a last slide to share from our side, because when Miguel and I sit, we deal with clients that panic. We sometimes deal with some of you guys that panic, and to say, listen, my client is so upset, their portfolio is down 15, 20%. They want to go all into cash and wait for this noise to blow over. And the risk of trying to time the market has been well documented over time. But just to reiterate that risk, and this is looking at an investment of 100,000 in the JSE All-Share Index for the last 10 years. If you've been invested fully for that 10 years, you would have had 170% return on the client portfolio. If you've panicked and you've moved your client into cash and then back into the market, and you somehow missed the 5 best months, that return drops to 71%. If you miss the 10 best months, it drops to 26%. And if you miss the 15 best months, your client's now having a negative return over that 10-year period. So it's risky business trying to time the market. Nobody gets it right on a consistent basis. So just to reiterate my starting point, when you sit with your client, do a proper investment strategy for the income bucket, the growth bucket, educate your client around the expectations for both those buckets over the short and the long term, and then use either the seed shortlist or the DFM models where you're going into good underlying fund managers that will give you those returns over the long run, and then invest and forget. Do not touch those buckets unless you're topping up an income bucket or unless the client's circumstances has changed drastically. Ryan, you've got your hand up.
Yes, thank you. Thank you, seed team. Thank you, guys. Always very slick. Really appreciate it. Just interesting, you were talking about a buying opportunity. Obviously, a lot of the questions now, both on and offshore, are, is there really a buying opportunity? There's a possibility of apparently a 7.5% interest rate hike additionally in the US. So there might be a window now, but a bit more pain again in the new year. What are your thoughts on that? Obviously, we're getting a lot of questions from the clients. Adrian, Miguel, and always a pleasure. How's it, Sean? Sorry, I just saw you now. So yeah, if you could just give us a little something, because so it's almost a feeling like there's going to be a sort of like the eye of the storm now before the beginning of the year. Your feelings on that, please, Adrian. I appreciate it. I'm going to put my hand down now. Thanks.
No, thanks. That's a great question, and you're right, certainly one that we're getting a lot. And it comes back to, I think, to strategy versus trying to time the market. So are valuations better now than they were a year ago? Yes. Is the market dirt cheap? Certainly not, especially if you're considering all the risks that's still at play and all the uncertainties that still hovers around us. So our advice would be, Ryan, to stick with the investment strategy. So if it's short-term money for the client, put it in an income fund solution. If the client is 30 years old and they're investing for retirement, put it in a balanced fund that will give you the most risk according to Reg 28. If it's discretionary money, look at an equity solution, but perhaps don't put it all in one go. So a lot of you guys are currently phasing in. So somebody's got a 2 million lump sum. They're going into equities, local and offshore. Let's add in over a 6 to 12 month period. If we are truly at the bottom, at least maybe 10 or 20% is going in at the bottom. If there's further downside, you're getting good cost averaging over the next couple of months. It looks better than it did a year ago, but could it go down further from here? Yes, of course it can run. So our advice is stick to the long-term investment strategy, short-term investment strategy, and for the riskier side of the investment piece, look at a phased-in approach maybe over the next couple of months. I hope that answers your question.
Thanks. Good advice as always. And thank you again, guys. Really slick. Thank you so much.
Pleasure, Ryan. Benjamin, you've got your hand up.
Adrian, it's Marinus. I'm using Benjamin's laptop. I just wanted to ask you on that. I think the second to last slide that you had, the risk of investing too conservatively. Can you maybe put something on the graph showing offshore equity on that as well? Because I see you have high equity and South African equity.
Yes, absolutely. We can do that. And in fact, maybe inflation as well, Marinus. We'll do that and we'll send that out.
Please, thanks. That will help a lot.
Okay, perfect.
Thank you.
Thanks, everyone. All the best there, man.
Any other questions, guys? Thanks for joining us. Great to see all of you. Thanks a lot. Good luck with those slides.
There you go.
And shout to Canal.